Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here again. Very good morning. Today will be Wednesday, the 10th of July, 2024. So before we start our Daily Dose of Market Insights for today, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right. So before, pardon me, before we jump straight into the short-term intraday technical outlook on the cross assets, that means i.e. the dollar major pair, the major stock indices, and as well as two key commodities that we tend to highlight on a frequent basis, that is gold XAU/USD and as well as West Texas crude oil. Let's have a recap what has taken shape yesterday in terms of the news flow releases, economic data, as well as its impact on the respective major cross asset classes. Okay, taking into account of the release of any important data that has taken shape earlier this morning, as well as the Asia session open. So let's start with the US session yesterday. So yesterday US session, primarily the key economic event, or I would say the news flow, primarily focusing on Fed Chair semi-annual testimony to Congress. So yesterday he addressed the Senate Banking Committee. So not much of a a shocking news flow. Everything seems to be much in line with the various Federal Reserve official public speeches, including Fed Chair Powell himself about a week ago. So overall, this is the 5 key takeaways from his testimony to Congress, saying that the options are open when the central bank will cut interest rates. So market is pricing in the first cut to come in September. So he did told over here subtly, which is the senator over here, told senator that he doesn't expect the next move will be a hike, but declined to give any timetable for a cut. So that's pretty much usual for a behavior of a typical independent central banker. Do not want to actually being viewed as being swayed towards political influence, given the fact that we know that this year is the US presidential election. So he don't want to see that yes, he starts to cut rates, but if he give a specific exact timing, he might be viewed as favoring the Democrats. And he also did mention over here is that recent inflation data has shown modest further progress. He said more good data will strengthen. Okay, let me highlight this part. Okay, seems to be a bit lagging. Okay, never mind. So just follow my mouse over here. More good data would strengthen the Fed's confidence in inflation returning to 2%, a condition for cutting rates. And also unexpected weakness in the labor market could also prompt a cut. So this is more in line what we have discussed earlier on, which I mentioned in my daily dose of market insights since the start of this week. Economic data in US has started to soften, pretty much evidence, given the Federal Reserve is actually operating in a data dependent mode. What do I mean by that? A contraction reading below 50% of the latest ISM services PMI data that was out 1.5 weeks ago, indicating softness or a losing of expansionary strength in the services sector in the US, which is primarily very important. Why? Because services activities contribute to close to 3/4 of US economic growth. And last Friday, non-farm payroll data, we see a slight uptick in the unemployment rate of 4.1%, and as well as the previous 2 months of monthly jobs added to the US economy. We talk about the US job market, i.e. has been revised downward for the month of April to May. So net overall, these are signs of softness, which has been pretty much addressed by Powell yesterday in his testimony to Congress. So that is actually telling us subtly the next potential move by the Fed is more or less a cut rather than a hike, but Powell can't tell us directly that he will cut in September, so he got to give a bit of hints over here. So with these hints that's being thrown to market participants yesterday, no change in the pricing of the we call it the bets based on the interest rate futures pricing from the Fed funds interest rate futures contracts, all right, as calculated by the CME Fed Watch 2. So this is the latest aggregated or combined meeting probability. So this particular table over here shouldn't be a big surprise to you guys who followed my daily dose of market insights. So for those who wants to get a latest insights of how the market is viewing the Federal Reserve monetary policy via pricing of short-term interest rate futures contracts, that means i.e. the Fed funds futures interest rate contracts, you can just Google CME Fed Watch 2, which is able to bring you to this page. All right, so without further ado, let me explain this table for you guys. So currently the Fed funds rate is at 5.25% to 5.5%, so no change in July. So July market is expecting the Fed to stand whole. Okay, that means this end of this month, okay, close to a high chance of 95% no change. That means neither a hike or a cut. Then the significant odds will start to increase in the September meeting on 18th of September. 77% chance, which is rather high. So that's 70 plus odds percent chance has remained the same since early this week on Monday upon last Friday release of that softness that was being seen in the US non-farm payroll data for the non-farm payroll data, pardon me. And thereafter in November, no change again, 79, close to 80% chance it will stand pat after that potential first interest rate cut in September at 5% to 5.25%. Then thereafter, we start to see a high chance of 96% of another interest rate cut before 2024 ends. That will potentially come in the 18th of December FOMC meeting. So overall, the markets has started to fully price in two interest rate cuts before 24 ends. So now going forward, right, the next meeting in July or in September, the market will look out for guidance in the Federal Reserve statement and as well as the next dot plot, which will be roughly released. So if you go to the Fed funds, okay, Federal Reserve meeting, the website over here. Okay, let me 1 second. Let the load. Oops, this. Yeah, the first one. Yep. Okay, so over here, what we could see over here is that the September one is very crucial. Why? Because the September, you notice that there's a star, little star here. So any little date, right, that has a little star at the end, it's where the Fed will release its latest dot plot projection. So what is dot plot projection? Dot plot projection is a medium projection by all the Federal Reserve officials where they view the Fed funds rate will be from a short term, medium term, and long term, as well as their projection on key inflationary trends and data in the US economy. So market will scrutinize the September meeting for hints of where the Fed funds will be next year going forward. So if you look at very quickly, right, next year over here, right, what market is expecting, right, in the first half of next year, that means there's quite an aggressive pricing of another consecutive interest rate cut cycle will take shape. That means after the second interest rate cut in December, in the 29th of January 2025, that's really next year, FOMC meeting, market is pricing in another 25 basis point cut at 61% chance to bring the Fed funds rate down further to 4.5%. All right, then thereafter, pause and another chance in April, another 25 basis point cut at 79% chance to bring it down to 4.25% to 4.5%. So it seems to me that market now is looking at every other meeting that could be a potential 25 basis point cut going forward in 2025, at least in the first half of next year. So this particular trajectory very important to see how does it change upon the release of the September dot plot meeting, okay, which is over here. Okay, 11 or this 18th of September. So something to be mindful of in a medium term perspective, because that could also change the trajectory of the dollar and as well as the trajectory of the treasury yield movement. Okay, so this last yesterday's important data release, and this morning we do have another two data release on highlight to your is China inflation. So if you look at China inflation over here, expand my screen, the inflation rate continues. Okay, the inflation rate in China, that means the CPI rate, continues to hover in the negative territory. So market is actually, okay, not suddenly, it's considered to be negative territory, on a month-on-month basis, but it starts to inch up slightly on a positive territory on a year-on-year basis. So you look at the month-on-month basis over here, consensus is expecting a negative 0.1% decrease, but it declined much further to negative 0.2%. So overall, on a year-on-year basis, it slipped slightly to 0.2% from 0.3% that was printed in May. This on a year-on-year basis, and it also came down below market expectation of 2 basis points at 0.4%. So market is expecting it at 0.4%. So if you look at the trend of the inflation rate on a year-on-year basis, over here, okay, it's after printing a highest reading so far this year at 0.7%. The rest of the year so far has been rather lackluster, as you could see. So if you look at the 5-year horizon trend over here, okay, it seems to us that inflation is still in a rather lackluster mode. That means, i.e., what we want over here is a return of a much more higher uptick in inflation rate. Why? Because China right now is still facing a potential deflationary scare or deflationary spiral that could get entrenched in terms of hammering or have a negative impact on consumer sentiment, business sentiment, which could hamper internal domestic spending demand, all right, in China, due to this lackluster inflation rate, more likely primarily driven by this property prices that continues to remains on a depressed levels. And one thing I want to highlight over here is, other than the CPI rate, they also do release the PPI rate. So the PPI rate is more on factory gate prices. So this is more like manufacturing input costs. So if you look at the manufacturing input cost so far, it has been much more brighter than the CPI. So there is actually some signs of an improvement in the inflationary picture trend in China. Manufacturing costs starts to tick up. So sooner or later, it should actually starts to spill over to the consumer prices. All right. Okay, so if you look at it over here, is that previously it was at negative 4% year on year in the month of May, and right now this negativity has starts to reduce further to negative 8% year on year, almost on is on par with consensus. So if you look at the PPI or the factory gate prices at this point in time, looking at the trend, notice that this is a 5-year trend. It starts to inch up much more significantly as compared to the CPI trend. Yes, I know that it's still in negative territory, but this negative territory has started to slowly reduce since the start of this year, and it's been sloping upwards. So indicating to us that factory gate prices or input costs of manufacturers, the cost of manufacturing input cost has started to increase steadily. So that could actually potentially slowly fit into CPI consumer prices as well. All right, so that could be a much more encouraging sign in terms of if you look at the overall picture of the inflationary trend in China, taking into account of the PPI data. All right. Now, another data I want to highlight for you all is today we have the RBNZ meeting. So for those guys who are looking at the Kiwi dollar, Kiwi dollar, or any of the Kiwi cross pair, no change in terms of interest rate decision at 5.5%. But however, during the statement itself, the RBNZ statement actually offer a hint of a dovish tilt. Okay, why do I say by that? Let me expand this data for you, this particular website. Okay, so the RBNZ, okay, just look at my mouse. I don't know why it's not highlighting. Okay, just look at my mouse over here. RBNZ has kept the official rate at 5.5% for the 8 consecutive time. So that's pretty much within expectation. But what market is not expecting is that the statement from the committee noted risk that the interest rate pain, okay, they actually highlight interest rate pain may be feeding through the domestic economy more strongly than expected. So it has been acknowledged that the current elevated high interest rate environment in New Zealand has a severe impact on the domestic economy. So that is more like a dovish hold instead. Okay, yeah, even though they put interest rate on hold, but the next move will be likely a interest rate cut in New Zealand. So it seems to us that right now more and more central bankers are actually getting less cautious in terms of inflationary trend. The only one that is always has a balanced approach right now is still the Fed. But based on yesterday's Fed Chair Powell testimony to Congress, he do give a subtle hint that he do acknowledge the current situation in terms of having a higher interest rate that could be detrimental to the economy, and as well as the recent labor market softness in the US, indirectly hinting the downward revision in the non-farm payroll data for the month of April to May that was kindly revised downward on together with the release of last Friday non-farm payroll data, together with the uptick in US unemployment rate to 4.1%. So how does it impact the FX market today on this particular shocking dovish hold by RBNZ? What we could see over here is that the dollar is actually spiking up aggressively on an intraday basis against the Kiwi. So, i.e., right now the Kiwi is the weakest performing currency against the dollar. You put it away that the dollar is the strongest against the Kiwi, and the rest of the other currency is just trading sideways. All right, so only the Kiwi is the outlier. So like I say, if I look at this chart over here itself, there is no clear dollar strength coming back into the picture. Why? Do not forget, everything is on a relative basis. And do not forget, yesterday, Fed Chair Powell, he did hinted that more likely the next interest rate move by the Fed is more of a cut rather than a hike. So that should explain the more of a sideways movement on the intraday basis on the dollar pair against the other major currency. But the dollar is the strongest right now as we are speaking against the Kiwi, due to that rather unexpected dovish tilt coming out from the RBNZ latest monetary policy statement, which I just highlighted a while ago, 1 minute ago. All right, so these are the key economic data and news flow I want to highlight to you guys. All right, right here, right now. Okay, so now let us now move on to the intermarket dynamics that I share with you guys for you all to actually highlight. So based on the current intermarket dynamics, let's start with the FX market first, as per se. So if you look at the FX market over here, what we could see, the US 10-year Treasury yield continues to remain lackluster. That means, i.e., it's going to show signs of softness rather than strengthening. As what we could see over here is that the price action in the past 2 days continues to be trapped below the 20-day, the 200-day, and the 50-day moving average. All right, and if you look at the shorter term one, the 2-year also continues to be much more drastically inclined by shipping a very clear lower low. All right, still below the 50-day, the 200-day, the 50-day, the 20-day, and the 200-day moving average. So also continues to also incline further softness. So at least on a medium term, it could actually kind of shape a retest on the next medium term resistance support level. Okay, at this zone here, 4.4%. All right, so with that soften of this US Treasury yield, and we do not have any key election right now from a major economy or from the major developed nation, because the UK economy election is out of the way, the French election is out of the way. So very likely right now, the sole movement of the dollar pretty much dependent on the movement of the Treasury yield. So with a weaker or softer US Treasury yield, both on the 10-year and the 2-year, that could also potentially starts to translate to a potential weaker dollar pair as well. So if you look at the dollar index over here, okay, so the dollar index continues to trade below the former breakdown of the minor range support, now turns into a pullback resistance at this 105.24% level. Okay, 105.24% level. So yesterday it tries to test the 50-day moving average and still below the 20-day moving average over here. So the next support level to watch out for, that means, i.e., if the dollar were to shape that down leg from here, very immediately we could see this minor area here. Okay, sorry about that. It seems to be quite lagging over here right now, my internet connection. Can't really do a proper move. Okay, 1 second. Okay, yep, push it up. Okay, so this 200-day moving average also highlighting the former minor swing low of 12th of June, acting as a support at this 104.46 level. Okay, so this is the first near-term support to watch on the dollar index. Okay, if we start to see a sign of a bearish candlestick thereafter, when the US session opened and more liquidity, when the European session opened, pardon me, where more liquidity coming into the FX market. Okay, so that is the intermarket, we call it analysis or dynamics, that I want to share with you all for today. Okay, a pretty short one for today. So right now, let us now jump straight to the intraday technical outlook on the various major cross asset classes. But before that, let me expand my screen so that you guys can see the levels much better over here. Okay, good. So let us start with the euro dollar. All right, so no change on the euro dollar. So the euro dollar, yes, it did shape that minor pullback over here, but this minor pullback came within our expectation and it's managed to help above the short-term pivotal support that we highlighted since since Tuesday. So it's a tightened one at 1.0790 over here, 1.0790. And what we could see over here is that the hourly RSI has started to very clear shape a higher low as well. And what we could see over here is that in the hourly RSI also managed to shape a momentum bullish breakout over here. Okay, can see very clear. Previously there was the resistance. This Asia morning momentum bullish breakout. All right, so with this momentum bullish breakout, it's still kind of indicating to us there's still some form of short-term intraday bullish momentum still inherent in this euro dollar pair over here. Okay, okay, seems to be hanging right now. Okay, push it down lower. Okay, good. Okay, so as long as this 1.0790 short-term pivotal support holds on the euro dollar, we'll still maintain that short-term intraday bullish outlook or bias, I would say. First near-term resistance zone to watch will be corresponding close to last Friday minor swing high 1.0850/1.0860, which is a Fibo extension cluster, as you can see over here from the low of 26th of June. Above 1.0860 exposes the next near-term resistance zone of 1.09/1.0925. Only an hourly close below 1.0790 will invalidate this bullish bias on the intraday basis to see the minor corrective decline since last Friday or this Monday to extend further to expose the next near-term support at 1.0770 and potentially even 1.0750. We also confluence with the 20-day moving average, I think, as a similar support level here as well at 1.0750. Moving on will be the sterling dollar. So very similar on the sterling dollar. What we could see over here is that on the hourly RSI, you also start to shape that momentum bullish breakout over here. Okay, during the Asia session. Okay, so net no change. What we could see over here is that where it actually shaped that bullish breakout. If I were to go to that hourly time, the daily time frame chart, previously it shaped that bullish breakout from this this medium term symmetrical triangle. Okay, sorry about that. I think it seems to be very lagging over here right now, my internet. So what we could see over here is that this dotted gray line is the upper limit of that former symmetrical range triangle that has been capping previous up move since 8th of March this year. And on last Friday, it did that bullish breakout. And thereafter, it consolidated. And yesterday, it did the intraday pullback. And it came very close to this pullback line, okay, which is the pullback support of that former symmetrical triangle range resistance, which we highlighted as our short-term pivotal support level yesterday at 1.2670. All right, still no change. 1.2670 short-term pivotal support level on the sterling dollar. Still maintain that short-term intraday bullish outlook or bias, supported by the momentum bullish breakout seen on the hourly RSI. Next near-term resistance to watch out for. Okay, let me put up a slightly lower one. Okay, because there's actually a very clear minor swing high over here. Okay, this level. Okay, because since it's an intraday outlook. So first near-term resistance 1.2816 level. Okay, this is the minor swing high of yesterday. Above 1.2816 exposes 1.2860 near-term resistance level next. Only an hourly close below 1.2760 that will put that last Friday bullish breakout in jeopardy. Why? Because it reintegrate back into the symmetrical triangle range configuration since it's below the dotted gray line. Next near-term support level to watch in first step will be at 1.2730, followed by 1.27 figure level, which is confluencing also with the rising 20-day moving average. Okay, that's for the sterling dollar. Now moving on will be the dollar against the major Asia Pacific currency, pardon me, starting with the Aussie dollar. So on the Aussie dollar, what we could see over here is that still no change. The price action going to trade sideways after hitting an intraday high of 6761 on this Monday. So overall, this movement over here seems to us that it's rather doing a consolidation rather a minor topish movement. Why? Because if you look at the hourly RSI, it continues to form a base, right? You could see a basing formation over here. Okay, it's going to form a basing formation, and this basing formation seems to came right around the 50 level mark as well. And if we could do a longer trend line support, okay, it actually bang off right at this ascending trend line since in place since the low of 28th of June. All right, so net overall momentum is still rather positive rather than negative, at least on a intraday basis, given that it's the hourly time frame. So with that, the first support level to watch was at 67.20, almost tested yesterday during the US session before it rebounded. So I don't want to put it so tight at 67.20. Why? Because it still couldn't break above this Monday intraday swing high. So still using 67 figure level as my short-term pivotal support level. So what's this 67 figure level? This 67 figure level also confluence with this dotted gray line. So what's this dotted gray line? So this dotted gray line, if you switch to the daily time frame, it actually indicate to us this is the former pullback support of that symmetrical triangle range resistance that was broken out on last Thursday. All right, over here. Okay, linking from the highs of 3rd of February. So net overall, as long as that 67 figure short-term pivotal support holds, okay, pardon me. Okay, sorry about that, it's a bit lagging. As long as 67 short-term pivotal support holds on the Aussie dollar, still maintain that short-term intraday bullish bias. Next near-term resistance to watch after that 67.60 level has been taken out. That means this Monday's intraday high will be at 67.80, followed by 68.25/68.40 next. However, if we start to see hourly close below 67 figure level, that means a breakdown with hourly close below 67 figure, that could put last week bullish breakout in jeopardy. Why? Because the price action start to reintegrate back below the symmetrical triangle range configuration. At least in the first step, it could actually shape a minor corrective decline to retrace last week bullish push up. Next support level to watch out for, at least in the near term on the intraday basis, if 67 figure is taken out, will be 66.70, followed by 66.40, also confluencing with the rising 20-day and the 50-day moving average. Okay, moving on will be the dollar yen. So the dollar yen right now is a rather tricky situation. So right now, yesterday it broke above the 61.40 short-term pivotal support resistance level, not support level that I highlighted, and right now trying to inch upwards to retest last Wednesday swing high at 61.95. So given the fact that the other dollar major pair is still showing no signs of dollar strength coming back into the picture, with the euro, the sterling, and as well as against the Aussie, I will have a rather neutrality stance today on the dollar yen. So neutral between 61.95 and 61.10 for now, unless we see a hourly close breakout above 61.95, then we could validate the start of a new impulsive up move again, where dollar yen starts to float in speculative move, ignoring the fact that the US Treasury yield starts to decline towards the next resistance at 62.40. Above it exposes the psychological level of 63 figure, also conferencing with a Fibo extension level of 2.618 that I drew from the low of 5th of June. All right, so that's for the dollar yen intraday technical outlook. Neutral for now between 61.95 and 61.10, given the fact that there's no clear dollar strength in other major pair like the euro, the sterling, and as well as the Aussie. All right, so that's sum up for the intraday technical outlook on the major dollar pairs, FX pairs, pardon me. So now let's take a shift down to the major stock indices, starting with the Asia Pacific's benchmark stock indices first, with the Hang Seng Index or the Hong Kong 33. So the Hong Kong 33 yesterday managed to recover as expected right above the 200-day moving average, hit the resistance level that we highlighted as well, 17,790, before inching back now. Okay, before there's this minor pullback in the last 2 hours in the Asia session. So what I could see over here is that this pullback over here managed to actually pause right at the former first resistance that we highlighted yesterday at 17,005 at this 17,585 level, and start to shape a kind of a bullish reversal hammer candlestick formation right now. It's still intraday because you got to wait for the hourly to close. So with that, I will have a tighten key short-term pivotal support right now, and so given the fact that the hourly RSI hasn't hit the overbought level yet at this juncture, so with a tighten key short-term pivotal support for today at 17,380. Okay, pardon me, it's a bit slow on the shift up. Okay, 17,000. Okay, give me a minute. So it should be this level here. Okay, 17,380. So as long as 17,380 holds the Titan key short-term pivotal support for today, potentially we'll still maintain that short-term intraday bullish bias on the Hong Kong 33 to see it further drifting up towards the upper limit of this minor descending channel that is still intact since 5th of June. Okay, only a clear break above this 17,970, then we will increase the chance of a much more pronounced recovery, because that is indeed a price action bullish breakout from this minor descending channel. But for now, we are taking one step at a time. First near-term resistance to watch, 17,790, which was yesterday's resistance, followed by the second resistance at 17,970, which confluenced with the upper limit of this minor descending channel that I drew from the high of 5th of June, and as well as the still downward sloping 20-day moving average acting as a resistance at a similar level as 17,970 as well. However, if we start to see an hourly close, an hourly breakdown below 17,350, then we will see a retest of that key support level at 17,170, which is the lower limit of this descending channel support, and as well as the key 200-day moving average acting as a support at 17,170, and also that former minor swing high of 13th of March and 10th of April, where it broke out and kickstart that rather steep up move that was seen on late April to middle of May. All right, over here. Okay, so that's for the Hong Kong 33. So now moving on will be the Nikkei. Moving on next will be the Nikkei 225 or the Japan 225. So the Japan 225 continues to push up higher, hitting the first resistance that we highlighted at 41,770. The RSI also continues to shape positive movement, higher low, and also starts to evolve within this ascending trend line as well, indicating to us that short-term momentum remains positive on the intraday basis. So with that, we will have a tighten key short-term pivotal support for today, slightly below today's intraday low, 41,400. So what is 41,400? In fact, the close to the lower limit of this minor ascending channel. So as long as 41,400 short-term pivotal support holds, we will still maintain that short-term intraday bullish outlook on the Japan 225 or the Nikkei 225. Next resistance to watch will be at 42,000 psychological level. Above it is the Fibo extension cluster level that confluencing at this 42,200 / 42,280. Only an hourly close below 41,400 will negate today's intraday bullish bias to see a start of a much more deeper minor corrective pullback to expose the next near-term support level at 41,090, followed by 40,800. That was yesterday's or Monday's pivotal support level that we tightened up further. All right, so that's for the Japan 225 or the Nikkei 225. Moving on, next will be the European major stock indices, which is the German DAX that we cover. So the German DAX or the German 30 continues to float down within our expectation, hitting the support level at 18,250 thereabout. So what we could see over here is that the previous movements on last Friday is more or less a bullish breakout. Why? Because price action now very clearly reintegrate back below this descending trend line that I drew from the current all-time high that refused to break since 28th of May this year. So over here, that breakout over that bullish breakout arising from that fiasco from the French election is more or less deemed as a failure bullish breakout, where price action now reintegrate back below this descending trend line. And right now it's attempting to actually break below the 20-day moving average after clearly taking out the 50-day moving average yesterday. So that was the first line of defense. After that breakdown, you see that steep price movement. So very clearly, today's movement over here, we'll be using 18,425 as the short-term pivotal resistance. This is the Titan one for today. But nevertheless, be aware that the hourly RSI now is at the oversold region, has already hit the oversold region, and now it's already exited from the oversold region. So more or less, there could be at least a minor rebound taking shape after yesterday's steep down move over here. So what we could see over here is that the minor rebound or the minor snapback pullback over here, at most, what we could see is that the first resistance to watch out for could be this region here. Okay, close to the 38% Fibo retracement. All right, the 50% is right exactly at the 18,425 short-term Titan pivotal resistance that we have. So potentially minor snapback rally. First resistance to watch 18,350, maximum 18,425. So as long as 18,425 didn't surpass on the upside, why this level is important? Because this level was being supported since 4th of July, and after yesterday, there's a clear hourly break below it. It triggered that steep intraday bearish steep decline. So for sure, this is indeed a key psychological level in order for the bears to resume its downside pressure. So like I said, as oversold, exited from oversold, potential minor pullback or minor snapback, I would say snapback. First snapback resistance to watch out for 18,350, maximum 18,425. So as long as 18,425 is not surpassed to the upside for today, that means there's no hourly close above 18,425. We will still maintain that short-term intraday bearish bias on the German DAX or the German 30. Next support level to watch, we're very clear this bunch of range support over here that is on hold, that managed to help prices on it since 21st of June. Now 18,085. Okay, below 18,805 exposes the swing low of 14th of June at 17,970. We also close to the psychological level of 18,000. Only an hourly close above 18,425 will invalidate today's intraday bearish bias to see another choppy push up again to retest 18,520. Above 18,520 may revisit last Friday and this Monday minor swing high at 18,640 next. Okay. US major stock indices. Let's start with the Dow Jones Industrial Average or the US Wall Street 30. No change, going to be trapped within this sideways range since hitting the intraday high on 25th of June. So close to about 3 weeks of sideways ranging configuration. Bottom of the range still at 39,090, 39,030. Confluencing with the rising 50-day and the 20-day moving average, as you could see on the hourly chart over here. So net, as long as 39,030 short-term pivotal support holds, still maintain that short-term intraday bullish outlook within this range configuration. Upper limit of the range 39,600, followed by 39,790, which confluence closely with this Monday swing high at 39,700, and this 39,790 also this minor zone area of former minor congestion area of 21st of May and 23rd of May. Now, moving on, next will be the Nasdaq 100. So over here, the Nasdaq 100 over here, before we talk about the Nasdaq 100, let's take a look at the heat map of the S&P 500. So you can see at the S&P 500 over here, yesterday, we do have a rather lackluster session on the mega cap stocks, but however, the mega cap stocks has been being supported by the outperformance of NVIDIA, which is the key leading semiconductor AI chip play. Okay, that is up 2.5%. So that should explain why Nasdaq 100 outperformed the S&P and the Dow Jones Industrial Average yesterday. So bearing in mind, NVIDIA has a significant influence on the Nasdaq 100. Why? Because it being the top three weighted market cap stock inside Nasdaq 100. So let's have a quick look at the technical configuration of NVIDIA, given that it had a potential significant influence on the movement of the Nasdaq 100. So if you look at NVIDIA over here, like I highlighted, the medium-term trend and the short-term trend continues to remain intact. Why? Because price action going to trade above the 20-day and the rising 20-day and the rising 50-day moving average. If you look at the daily RSI, also continues to slope upwards as well by having a series of higher low. Okay, right now hasn't hit the overbought region yet after shipping that initial pullback. So this could be a start of a new momentum up leg on a medium-term basis, since this is a daily time frame chart. And what's interesting over here is that you look at the price action of NVIDIA yesterday, it managed to continue to trade higher above the rising 20-day moving average. And what we could see, yesterday's volume has started to increase as well. That means we start to see a gradual volume increase together with the price action trading above the 20-day moving average. So this actually explained to us or inferred a rather healthy bullish up move right now that is being seen in the price of NVIDIA, potentially holding above the 20-day moving average. Now, with that positive price movement of NVIDIA, that has been more or less been reflected in the positive price movement on the Nasdaq 100 as well. So if you look at the Nasdaq 100 yesterday, we do highlight the first support level to watch out for will be at around the 20,420 level, which the price action actually hit yesterday during the start of the US session, and thereafter it managed to survive, trading rather sideways in a rather lackluster small little candlestick formation. So with that, if you look at the hourly RSI, okay, the hourly RSI also managed to find some support right at this rising trend line, okay, that I drew from the low of 20th of June. Okay, supported yesterday, supported as well. And after it bounced off this support, it rose above the 50 level mark over here. So indicating to us that short-term intraday bullish momentum remains intact on the US Nasdaq 100, because it's the hourly time frame. So still no change. I don't put it so tight at 20,400 or 420. Still use that 20,220 level. So as long as 20,210, okay, 20,210 short-term pivotal support holds, we will still maintain that short-term intraday bullish bias on the Nasdaq 100. First resistance to watch out for, Fibo extension cluster level 20,620/20,710, followed by 20,900, which is close to the upper limit of this minor ascending channel that I drew from the low of 21st of May. Only an hourly close below 20,210 will invalidate today's intraday bullish bias to see a much more deeper corrective minor pullback to retest 19,850 near-term support zone, which confluence with the lower limit of this minor ascending channel, and as well as the rising 20-day moving average, also acting as a support at this 20,000, 19,850 near-term support zone next. Okay, now let us move on to the commodities market, starting with the gold XAU/USD. So gold XAU/USD yesterday managed to survive again right at the lower limit of our short-term pivotal support, 2,350 mark level, bounce off. So still no change, still maintain that 2,350 mark. So for sure, this is indeed a key intraday short-term support, tested 3 times on Friday, on Tuesday, and as well as on Tuesday, on Monday and as well as on Tuesday yesterday. So as long as 2,350 short-term pivotal support holds, still maintain that short-term intraday bullish outlook on gold XAU/USD. Near-term resistance to watch. First one will be at last Friday minor swing high 2,391. Above it exposes 2,410 level. Okay, which is this former minor congestion area here of 21st of May to 22nd of May, and as well confluence with the Fibo extension of 2 times from the low of 26th of June. However, a breakdown below 2350, that means a breakdown below 2350 level, will invalidate today's intraday bullish bias, validate today's intraday bullish bias, pardon me, a bit of tongue twisting, to see it floating down towards the next near-term support level at 2,335, followed by 2,318 next. Okay, lastly will be the West Texas crude oil over here. Okay, West Texas crude oil, yesterday it continues to drift downwards. All right. Okay, 1 second, it's a bit slower. Okay, going to drift downwards over here. So hitting the 20-day moving average, I think, as a support level. Okay, so that is our support level to watch out for to maintain our bearish bias since Monday. So given that this support level has already been met and we start to see some form of bullish divergence that has already started to take shape on the hourly RSI. So potentially over here, that could be a minor corrective counter trend rebound taking shape to retrace certain portion of this intraday decline that was seen on last Friday. All right, over here. So as we know that price action don't move vertically downwards. So with a bit of with that bullish divergence that's being spotted on the hourly RSI, so that actually indicate to us that this could be the end of a first minor decline, first minor corrective decline, given that it could be a 5-wave down as well. Okay, so 1, 2, 3, then 4, 1, 2, 3, 4, 5. All right, potentially. All right, so okay, 1, 2, then 3, 4, 5. Okay, so with that, that could be a retracement of at least 50%, since there's a 5-wave down on the on the hourly time frame. So the 50% and the 61% lies around at the 83/85 resistance level. We also confluence with this former bunch of congestion area over here as well. So with that, I'll be using 8130 as my, which is the minor swing low area of 20th of June, 8130 as my short-term pivotal support. So as long as this support level didn't surpass to the downside, that means there's no hourly close below it, potentially the West Texas oil could shape this intraday retracement to retrace last Friday decline. All right, so we flip to a short-term intraday bullish bias for this potential retracement or a minor counter trend rebound to play out, as long as 8130 short-term pivotal support holds. First resistance, the resistance to watch only at 83/45. Why? Because we are not expecting a further move up, because we start to see 5-wave down. So after a 5-wave down, likely will be a ABC, then followed by another 5-wave down before we are talking about a much more potential pronounced recovery thereafter. So that could be around the 50-day and the 200-day moving average. Okay, but however, if we start seeing hourly close below 8130, then this minor counter trend rebound scenario will be invalidated to see the continuation of this impulsive down move to expose the next near-term support level at 84.56 and even 79.90, which confluence with the 50-day and also close to the 200-day moving average. All right, so that's sum up for the intraday outlook on the major cross asset classes. So before we go, let's have a quick look at the economic calendar for today. What are the data to look out for? So for today, we do have a rather quiet US session and a European session as well. So at 9:30 p.m. Singapore time, we do have a BOE official, Bank of England official Peel speaking, and we have the second semi-annual testimony to Congress by Fed Chair Powell at 10 p.m. Singapore time. So this semi-annual testimony where Powell addressed to Congress. So yesterday he addressed the Senate, and today he will address the House of the Republican, the House. I'll say the House. All right. So that's how the structure the US parliamentary system goes. So at 10 p.m. Singapore time. So that shouldn't be a major change or major shocking, but usually the statement will be more or less the same as yesterday based on historical trend. So after that, what we have over here, we do have this we have the one that's related to West Texas crude oil potentially is the weekly EIA US stockpile change, because this is released on a weekly basis. So this for the week ending 5th of July. So that is coming in at 10:30 p.m. Singapore time. And thereafter, it'll be a quiet session over here. Okay, and at 2:30 a.m. Singapore time, we do have another Fed official speaking, Fed official Gooseby speaking at 2:30 a.m. Singapore time. Then early Asia session, we have another federal official speaking, Fed Cook at 7:30 a.m. Singapore time. Then thereafter, it will be a pretty much quiet session. All right, for now. Okay, so with that, that sum up today's daily dose of market insight. So I wish you all a great day ahead. This is Kelvin here signing off, and we shall speak again tomorrow. Thank you.